Hi, this is Gary. In this tutorial we're going to discuss how a put option works. Now essentially a put option grants the holder the right but not the obligation to sell an underlying asset, which is typically 100 shares of a stock, and we can sell that asset to another party at a fixed price for a certain amount of time. I have Yahoo stock below, and I'm going to use that as an example. We're going to take a look at options expiring on Friday, April 19th of 2013. This was made in early April. And we're going to take a look at the options with a strike price of 24, and these are put options here. And what you see here is the bid ask. The ask is the price that you buy the options at, and the bid is the price that you sell the options at. If you'll notice that the ask is higher than the bid, and that's what we call a bid-ask spread, or transaction cost, in addition to the brokerage fees you pay. So in essence, when you buy an option, it's like holding an ice cube. The longer you hold it, the quicker it evaporates, or the price evaporates on you. Now, for our example, we are going to assume that we buy this put option, and I'm going to round it up to $1. So we're paying $1 for it, and it expires on April of 2013, and it gives us the right, but not the obligation, to sell 100 shares of stock. In this case, it's YHOO or Yahoo for $24 a share. Now I'm going to switch screens here. We're going to take a look at the potential payoff on the option. We're first going to look at it from the option buyer's standpoint, and I've got that in green. If you'll notice, we paid $1. So that's our premium, and that's the maximum loss we can have as the option buyer. Now, on the other part that's important here is our strike price, and in this case our strike price is at $24 a share. And our graph is going to look something like this, with the $24 share being the pivot point where the graph changes, and the $1 amount right here, that's the maximum we can lose. This point I've highlighted in white right here is known as the break-even point, and in this case it is $23. That is the point the security has to go to at expiration for us to cover our $1 premium. Now let's take a look at what the maximum profit an option buyer can make on this, and it's fairly simple. We take the maximum profit we can earn is $23 in this case, and we get that from taking the $24 a share strike price, and then subtracting the $1 premium we paid, and 24 minus 1 equals 23. Now on the flip side, the maximum amount we can lose is $1, and that is the amount we paid for the premium. Now we are going to take a look at this from the option seller's payoff standpoint, and if you're guessing about how this is going to look and you're guessing that it's inverted, you are correct. I will draw a line to that right there. Now, the option seller's payoff is the opposite of what the option buyer's payoff is. In this case, the maximum profit an option seller can earn is the $1 premium paid in this example for the put option. On the flip side, the maximum loss an option seller can have is, in this case, it's going to be 23. And that's the difference between the $24 a share, the strike price, and then you subtract the $1 premium the option seller received for writing it, and that gives us 23. In this part, we're going to take a look at how the put price premium is affected by different factors. The first factor we're going to take a look at is the stock price. Now, all of these factors I have are going to be in red or green. If it's red and it's pointing down, that means the higher that item goes, the lower the put premium will be. And if it's green, that means the higher it goes, the higher the put premium will be. So with stock price, the higher the stock price goes, the lower the put premium is going to be, all else being equal. The next item we have is the strike price. For put options, the higher the strike price, the higher the premium is going to be. Our next factor for put premium or put option prices is interest rates, or as I refer to our RFR, the risk-free rate. Typically speaking, the higher an interest rate is, the lower a put premium is going to be. And the reason for the inverse relationship is probably best explained in my option tutorial on put call parity, where you create a synthetic put option and it gives a different relationship between the corresponding prices. Moving on to our next factor here, and that is volatility or standard deviation, as I have it there. And by standard deviation, I mean how does the stock price vary from the mean. I have a picture here of volatility. On one side, in light green, I have low. And the side in red, I have high volatility. Typically speaking, the lower the volatility, the lower the that component of the put premium is going to be. And the higher the volatility, the higher the put premium is going to be, all else being equal. And that brings us to our last factor, which is time. The longer the time on an option, the higher the put premium is going to be, and the closer a put premium gets to expiration, the lower it's going to be. We are going to take another look at how the premium is affected when it gets around the strike price. Now, these items I have right here that we just covered, volatility, stock price, time, interest rates, or risk-free rate, strike price, those all affect how the premium goes. And we're going to take a little more in-depth look at some of the other items from delta to gamma. First off, when you think of the premium as a number, or to calculate it, the premium is going to equal the option price currently trading in the market, and then we're going to subtract it from the difference in two things, and that's the difference between the strike price minus the stock price for puts. So just to think of an example here, if we have an option that's priced at $10 and it's put option to sell stock at 30, and the stock is currently trading at 25. We take 30 minus 25, which is 5, and we take 10, and then we subtract the 5 number from that, and that gives us a premium of 5. Now, when a put option, or a call option for that matter, is out of the money, the premium is just going to equal the option price, so it makes it really easy to do it in terms of we don't have to have the right side of the equation. We just take that away, and essentially the premium in that case is going to equal whatever the option price is. Now we're going to take a look at delta here, and delta is essentially the change in the option price divided by the change in the underlying price. I have some yellow arrows I've drawn there, and I've circled the corresponding parts on the graph. Essentially what delta measures is, as we move on, how much do we expect the premium to rise or narrow. Let's say we move from the strike price to the number 20 I have on the graph. How much is the premium supposed to change, or how much is the option price supposed to change there? So that's what the delta measures. Now the gamma, on the other hand, is going to measure the delta's price sensitivity. Typically, it is the highest near the strike price, which I haven't read, and also near the expiration date because of the amount of uncertainty. We don't know what it's going to close. It could have the stock, underlying stock could have a huge price change. If it goes one way, not so bad. If it goes down for puts, that's not very good. And that essentially concludes our tutorial on how put options work. Thank you for watching.